Hello, everyone. So today we will discuss this question, public sector accounting and reporting. One, this is an April paper. So the question we will be taking through is question one, which has 20 marks. So the question one says, describe the criteria that must be met for an uncurrent asset. An uncurrent asset. For example, a PPE, to be classified as held for sale in line with IPSAS, IPSAS 44, non-current asset held for sale and discontinued operation. That's 6 marks. B, in view of IPSAS 3, accounting policies, changes in accounting estimates and errors, analyze the accounting treatment of changes in accounting policies, changes in accounting estimates, and prior errors, 6 marks. Then C, we will find out what this question is asking. On 1st July 2020, Ufanisi Fund, a state agency, invested 85 million in an 8% bond at a discount of 6%, incurring transaction cost of shilling 2.6 million. Interest is received annually in arrears, and the bond will be redeemed at a premium of 4,230,000 above the nominal value on 1st July 2024. On 1st July 2024. The effective interest rate of interest is 10% per annum. The state agency holds investment of this nature until maturity. So that is the complete question, and that is 8 marks. So a total of 20 marks. So required. So the first one we'll start with. Describe the criteria that must be met for an non-current asset to be classified as held for sale in line with IPSAS 44. So what is this criteria? For example, a ministry blocks and it is kept by being used. Yes. So the office, like the service it provides, is as it is used, or the house as the staff uses it. So they both deliver surfaces. So they both deliver surfaces. So that is a working asset. That is a working asset. And therefore, what we normally do is we normally spread the cost of that asset. That is the cost of that working asset, the cost of PPE, the cost of building, the cost of that land over the useful life of that asset. And we call it depreciation. So we depreciate that asset every year. Why? Because we will hold that asset for the next 10 years. For the next 10 years. Now, when we talk about an asset as held for sale, that is the moment the entity decides to seriously sell that asset. So the dynamics, the economics will change. So the only way you can recover the value from that asset is not through the continued use of that asset. Why? Because you no longer need it. It is maybe idle. Idle, sometimes an asset can be idle, but for future use. But this one is not idle. This one is you no longer need that asset. And the only way you can recover value from that asset is through sale and not through continued use. So if we talk about depreciating such an asset, it won't serve the purpose, and therefore depreciation stops. With the way we used to measure that asset, where we say the historical cost model, uh, the current value model, we no longer use those. We will use lower of cost. It is similar to inventory. So we take the lower of carrying amount and fair value less cost to sell. So the lower of the original MBV and fair value less cost to sell. So now let us look at instances or the criteria that is required for an asset to be classified as held for sale. What is this criteria? Criteria one, we normally talk about and say available for immediate sale, again in its present condition. So what does that mean? If, for example, an entity needs, an entity needs 2 years, their staff can use for the next 2 years, and then they can go to another office which they are currently building. That one, we say it is not available for immediate sale because you already need it. The need is there. So you cannot sell. So it's not available for use. Then the second one, we say commitment plan. Commitment plan. What is this commitment plan? Like the authority have approved, like at the level of the authority, there is commitment. The entity is commitment. It's not just an idea, a paper strategy. It is part of the plan, and the management are committed to sell that asset. Again, the third one is an active program to locate a buyer. Like you have appointed maybe an agent, you have put a price tag on the asset for sale, you have marketed on the TVs or somewhere else. So there is an active program to find a buyer. So if we look at all this, if one is missing, then you will know that you are not ready or it's not immediately available for sale. Like for example, management have not approved. That asset is not already available for sale. Again, you are not looking for a buyer. That again shows that the asset is not available immediately for sale in its present condition. Then here, marketed, marketed. So when you talk about marketed, we talk about a reasonable price. For example, if I price a vehicle that is 1 million and I say this vehicle is 2 million, will it fetch money from the market? No, that is impossible. So we talk about marketed at a price near the fair value, a reasonable price, a reasonable price. And then highly probable, highly probable. When we talk about the sale is highly probable, like it is expected, it's more than likely that the sale will be completed and the entity is unlikely to change the plan, except for something which is unforeseeable, something which is beyond that entity control, that entity control. So now, uh, we are done with question 1A. Let us move to 1B. So in view of IPSAS 3, accounting policies, changes in accounting estimates and errors, analyze the accounting treatment of changes in accounting policies, changes in accounting estimates, and prior period. So, uh, this IPSAS 3 asks us one question, and it's us to decide what changed. Like, we have audited the financial statements. So what changed? That is the question you are asking. What changed? And this change can be three types. The first one is policy. So the change can be three types. The first one is policy. So the rule has changed. There is a change in accounting policy. There is a change in accounting policy. The entity now values its inventory, for example, on a different basis. On a different basis. So the rules have changed. Maybe you are using IPSAS 13 and now you're using IPSAS 43. The rules have changed and that's why you apply. Okay? So policies go backward. Policies go backward. And then there is an estimate. An estimate. So there, the first question was what changed? For the policy, we say the rule changed. And now, for the estimates, what do we say? Estimate, we say a number changed. A number changed. Why did the number change? A new information arrived. That is a change of estimate. For example, a vehicle expected to last 10 years is now expected to last just 6 years. You see? Or ECL or budget provision has worsened. So a provision is revised. So, and for estimates, we say estimates go forward. Estimates you don't go backward. Estimates you don't. So when we are talking about retrospective and prospective. So for estimates is prospective, going forward, going forward. Okay. So it will only affect the current and future periods. You won't go back. Unlike the policy, you won't go back. And nothing behind is reopened. What was audited will remain audited. You continue from where you left. Yes, because yesterday's estimate was the best judgment available yesterday. It was not wrong. It was just superseded by the current estimate. So that is the case. And then finally, we say an error. What changed? An error. What's this error? For example, were the books wrong? Like the information that was available was not used or misused. So that we can say it's a prior period error, an omitted transaction, a formula mistake, a misapplied policy. These are the types of errors we are talking about. Errors when material. Errors when material. You go backward. When immaterial, you just move forward. So if it is material, we restate the comparative prior period, the period that carried the error. So the same applies to the policy, but not to the estimate, not to the estimates. Okay? If it is older than say 1 year, 2 year, 3 years, say 2 years, and it is earlier than the comparative period, what do? We say restate the period opening balances. So that the statement must read as if the error had never happened, as if the error has never happened. So, uh, C. Now we can move to C. On C, on July 1st, 2020, on July 1st, 2020, Fundi Ufanisi Fund invested shilling 85 million in an 8% bond at a discount of 6%, incurring a transaction cost of Kenyan shillings 2.6 million. Interest is received annually in arrears. The bond is redeemed at a premium. So we have premium. The bond here is redeemed at, we have premium bar or discount. So here is a premium above nominal on 1st July 2024. So from 2020 to 2024, that's 4 years. So the effective rate is 10%. The IRR, the EIR is 10%. Illustrate the accounting treatment for the year ended 30th June 2021 to 2024 to the nearest thousand. So let us begin. The nominal value, the 8% bond, is 85 million. So here we will write 85,000 because you are told to the nearest thousand. Then the price, like, please note this, you are given 6% discount. So it means virtually what the investor paid is, what the investor paid is, what can I say? It is this only. What the investor has paid is this. That is what the investor has paid. Just 79,900 because it's 94 of 85,000. That's what the investor has paid. So, and that is where we will start our calculation. For both the investor and the person who has purchased, they both start at what they paid and what they received. Okay, 79,900. Next, we move to the next one. What do we add? Here we are told to add what? The transaction price. The transaction price. So it is what they pay, what the investor has paid. So first you paid 79 and then out from your packet you also removed 2,600,000. Remember this calculation we are doing in the books of the investor, in the books of the investor, in the books of the investor. Okay, then how much did the investor pay in total? You just add them together. You just add them together. That is 82,500. 82,500. Now, we know what the investor has paid. We know what the investor has paid. We know our current carrying amount, the NBV, as 1st July 2020. And we are told it will be held to maturity. It will be held to maturity. Now, what are we expected to do? We will come up with the amortization schedule. We will come up with the amortization schedule. So it is 4 years of cash. So on year one, we have invested 82,500, or the investor has invested. So they have invested 82,500. On year two, so every year, beginning on the end of the year, the investor will be paying 6,800. What's this 6,800? Will be receiving 6,800. What's this 6,800? So the purchase price, the purchase price, the purchase price was 85. And then the rate we are told is how much? How much? Is it 10% or 8%? Is it coupon rate is 8%. You see? So 8% of 85 is the cash flow payment. This is the cash flow payments. It's 8% of 85. You understand? That is what we'll be paying every year as cash outflows. Cash outflows. So you base it on the coupon. You base it on the coupon, and it is 4 times. So what will be paid is four times. What will be paid is 4 times. Now, on the time of redemption, on the time of redemption, the person will pay on the time of redemption. What you will pay is 89 to that. How are we getting 89 to that? We are getting the 85,000 plus the premium which you are told. So now, normally in this exam we were given the 10%, but sometimes you might not be given the 10%, and we need to calculate the EIR, the EIR. So we need to calculate the EIR if you are not given. So I will show you in exam in another time as we deal with these calculations. So the 85 plus 42, eventually that is what will be paid. So the cash flow is 68 times 4, 68 times 4, which is about 27 plus 89. And this totals to an amount, this totals to an amount of 116 for that, 116 for that. Okay. So why is 68,200 is not an income? 6,800 is not an income. This is just cash inflows. It's not income. The interest is income. So the 27,200 is what you will be receiving as money in the cash flows. So what is the income? The redemption receipt, the total redemption receipt is still the 85 plus the premium is also a receipt. So this is the total cash flow collected, which is 116 for that. Remember, you have invested how much? You have invested 82,000, something to closer to that, 82,000. And now it has become 116. So the difference is your income. But then, as we do the amortization, so the earning is 33,930. So we take first the 82 minus 116. So the total earning. But then we don't calculate this way. I will show you as we amortize these things. I will show you as we amortize. So the single rate that spreads is 33,930 over 4 years, which is 10% income each year. And by the way, these are sometimes we normally find in two ways. Uh, we find IRR using IRR, or the other one is NRR. So we normally find, or another time you can use goal seek. Another time you can use goal seek. Okay. Okay. Here I am. So next one, let us do the amortization. This is our table. Our table has opening, has income, has the coupon, has the closing. So we'll start with the 82,500 as our opening balance. These are the years. 82,500 is our open. So what is this income? This is the income. It is the interest. So you take, you take 82,500 times the 10%. That is our income, the first income. That is our first income. Next, the coupon, how do you get? This is 8%. You remember the 8%? These are the cash outflows or inflows, depending on who is calculating. So this 6,800 is 8 times the 85. 8 times 85. And it is a consistent figure. So we take this 82,500, we add this, these two, then we minus or add again because already the sign is minus, then we get the closing balance. Whatsoever we close with is what we will start with. Whatsoever we close with is what we will start with. And the way you can see, this is what we close and this is what we starting. Again, we repeat this. We repeat the same way we were doing. We repeat this one multiplied by this, 10% multiplied by this, then this state is constant until the final period, and then you plus all of them and you get this one. And then this 85,545 becomes the opening balance for 2023. And then we continue times 10%, you get our income, then minus the cash flow, and then you get the closing balance. And then 2024, the opening, the closing for that period is the opening, and then we multiply by the interest, and on the final year we pay this coupon first, but we'll also pay the total amount, the 89,230. And this 89,230 is tying to what we talked about. If this doesn't tie to the premium or to the information you were given, then go back to your calculations and look for why it is not tying, why it's not tying. So, uh, the ledgers, here are the ledgers. What do we debit on year one? We debit the cash received in the bank. Assets are normally debited, and we debit investment in bond 1450. Why 1450? Why 1450? And what do we credit? Finance income 8250. 8250. So we have received this in cash. We have received, and we have also, so normally the difference increases our bond. So that's why you will find this one will be part of our closing balance. This one will be our part of our closing balance. You won't write it as one in your books. It will be part of your closing balance, the 1450. If you go back to the earlier slide, you will see that. And then we will credit an income or revenue is always credited. An income or revenue is always credited. So what each year statement shows, in the statement of financial performance carries income, position carries the growing bond. So 2021 finance income, investment is the closing balance that goes to the statement of financial position. And that is an uncurrent asset. And that is an uncurrent asset until the final year. So I think this is a simple question. And then on the final year, even this one, on the final year, even this, if it is paid at the end of the year, it will be zero. At the end of the year, it will be zero because redemption falls due on 1st July. So we normally close our year on 30th June. That's why it will appear as a current asset in our books. Thank you for listening to me. Today, this is question one. The paper is April exam paper, public sector accounting and reporting one. So join me in my next classes as I take you through these past papers or revision to past papers. This is question one. Next time we will do question two. Thank you and enjoy your day. Thank you and enjoy your day.